The California housing market is about to get a lot worse, especially when we're talking about home sales and housing affordability. With mortgage activity at a 2-decade low and mortgage demand dropping to the lowest level that we've seen in nearly 3 months, that in turn means there's less buyers out there in the market looking to purchase homes, which in turn is going to result in less transactions. On top of that, you have mortgage rates hitting the highest levels that we've seen in nearly 6 months, peaking just a few days ago at nearly 7.17%. In addition to that, you have inventory just trickling to the market, which in turn is what is keeping house prices stabilized. On top of that, we've got the Fed, we've got inflation, as well as employment that we need to talk about in order to figure out what the future of the California housing market looks like. But before we do that, I want to take a minute and ask a favor. If you find any value in my videos at all, do me a favor and hit that thumbs up. Not only does it help the YouTube algorithm push it out to more people, it ultimately helps me accomplish my goal of helping educate home buyers and home sellers on this crazy housing market. In addition to that, I'm trying to reach 100,000 subscribers, so I would be very, very grateful if you hit that subscribe button. So fortunately, this past week, we got the House and the Senate to agree and ultimately come to an agreement on extending the debt ceiling. And with that, we saw volatility in the market subside a little bit. We saw interest rates come down a little bit. But then once again, the market was shocked with stronger than expected news on the employment front. The first thing we have is the JOLTS data showing strength in the labor market. Now, this is the job openings data, and it's currently sitting at just over 10 million jobs available here in the US. And most people would look at that and go, there's a lot of available jobs. And in turn, that must be really bad for the economy because no one wants to fill these jobs. When in turn, it's actually the opposite. What happens is the Fed looks at these job openings as actually a negative because what it means is a lot of these employers are going to have to raise wages in order to get employees in there to work. And in turn, that could create wage inflation and ultimately put more money in the pockets of employees who will then go out there and spend it in the economy, in theory, pushing inflation higher. And that's exactly what the Fed is trying to avoid. They're trying to actually raise unemployment because by doing so, that slows economic growth and in turn brings inflation down. But speaking of employment, we did see jobless claims tick up this past week, but still showing that there's strong labor demand out there in the market. Ultimately, the labor market is only slowing marginally, as the number of Americans filing for new claims for unemployment benefits increased only modestly last week, while private employers hired more workers than they had originally expected in May. Ultimately, this points to continued labor tightness that could ultimately push the Federal Reserve to keep interest rates elevated. On top of that, we had the BLS, the Bureau of Labor Statistics, report that payrolls increased by 339,000 jobs in May, which is way better than the 190,000 that the Dow Jones had expected. But at the same time, we did see the unemployment rate rise to 3.7% against the estimate of 3.5%, which is the highest unemployment rate that we've seen since October of 2022. So if you're watching this going, okay, jobs increased, but unemployment went up, how does all of that work? Exactly. It ends up being two different surveys in how they report these numbers, which is absolutely confusing and not something to ultimately worry about. What you need to worry about is how those changes in employment ultimately affect volatility, because volatility affects interest rates. On top of that, we are still seeing inflation run way too high versus the Fed's target measure of 2%. Now, part of the reason that the inflation numbers are still reporting really high is because of the way they measure some of this data. I've talked about it in other videos. The Fed essentially gives way too much attention to lagging data, which is ultimately the reason that we're in this problem now. For the better part of 2 years, they were saying that inflation was transitory, and they did absolutely nothing while still offering quantitative easing and pumping money into the economy. But now we're on the flip side of that. The Fed has hiked interest rates 10 different times, which ultimately takes time to trickle through the economy. It doesn't happen immediately. And what the Fed is doing is they're paying attention to the data right now versus expectations of where we'll be in a couple of months. And because of that, it's creating volatility in the market. One day, Fed traders out there are expecting the Fed to hike the Fed funds rate in June. And then the next day, they're signaling a potential pause, which ultimately has the market in a whipsaw. The market doesn't like volatility. So until we get some certainty in the market, chances are we're going to be on this roller coaster of interest rates, which means that you're not likely to see interest rates move significantly lower anytime soon. And that's going to continue to affect housing affordability on top of the low level of inventory that we mentioned earlier. At the moment, we have nationwide inventory sitting somewhere around 433,000 homes. And while inventory is growing, it's not likely to make any significant changes anytime soon because we're past that peak in the market where you see the majority of inventory come to the market, which is that spring market. We're now moving into the summer market, which is usually a little bit slower time of the year than the spring market. So my guess is you're likely going to see inventory nationwide peak sometime between August and September. And because that means less new properties coming to the market and interest rates aren't likely to improve significantly, that means less transactions actually happening in the market. In addition to that, you're going to get some really disappointing data when it comes to year-over-year house prices because May of 2022 was essentially the peak in prices for most housing markets out there. When the May data is actually released in June, it's going to be comparing this past May to the previous May, which is ultimately going to show big declines. But at the end of the day, it's all about context, understanding what that data actually means. Because at the moment, what you're hearing is nationwide home prices are falling everywhere. Well, if you actually take a look at this chart here, this shows the change from the peak with regards to different markets out there. And as you can see at the top of the list, you have Boise, Idaho declining just over 11%. Well, Boise was one of the hottest markets, if not the hottest market in the United States, appreciating nearly 40 to 50% in just a 2-year period of time. So it would be expected to actually see that market pull back, a lot like many of the other markets on this list. Now with that, I want to take a minute here and specifically talk about California. There was a handful of California markets on that list seeing price declines, but when you pay attention to the markets that actually have those price declines, those were the most overpriced markets in California, which at the end of the day doesn't really help the first-time home buyer out there. And that's largely why I believe that the California housing market is going to remain stable. It really comes down to supply and demand. As you can see from this chart here, California inventory sits at nearly the lowest level that we've ever seen on record. In fact, if we continue at this pace, we're likely going to see inventory move under the 2021 levels, making it the lowest level of homes available that we've ever recorded. Now, with that, demand is likely to continue to subside as well because many home buyers out there are affected by these high interest rates. That means you have less able buyers out there in the market. But here's the thing, when you have both supply and demand going the same direction, that likely means you're going to continue to have balance in the market. Now, if we saw demand subside substantially and we saw a ton of new inventory come to the market, then there is a chance that you would see home prices move further down. But what I'm seeing at the moment is many sellers out there not wanting to sell their homes because they have a super low interest rate on top of looking at the available inventory in the market saying that there's nothing out there for me, so I'm not going to sell my home. I'm just going to stay put. So at the end of the day, the only people selling their homes right now are people that are relocating or people that absolutely have to for one reason or another. Maybe there was a death, maybe there was a divorce, or maybe somebody has just completely outgrown a home, in which case they may trade their lower interest rate in for a high one, but the majority of people out there aren't going to do that. So what actually happens if interest rates continue to move up? If interest rates continue to move higher, that means less transactions out there in the market. It means inventory is likely going to continue to build, right? Because you'll have less demand out there, people buying those homes. Doesn't mean you're going to have a lot of new listings coming to the market, but it just means those homes on the market are likely going to sit and new homes will build, so inventory will increase. But here's the thing, it's not going to increase significantly, at least in my opinion. But on the flip side, what happens if interest rates go down? Well, we already saw what happens if interest rates come down, as we saw it back at the earlier part of the year. It's going to spur some buyer demand because it helps with housing affordability. It helps people increase their buying power, which is exactly why we saw home prices rise in March. And another reason why Case-Shiller is saying that the home price declines might be over. But here's the thing, I don't necessarily agree that the price declines might be over. I think you're going to have a sluggish market for some time, but that in no way means a crash. And that's exactly why I also don't agree with Elon Musk, who says that the next thing to tumble is going to be house prices. At the end of the day, real estate is local. So just make sure you know what is happening in your market, because what I'm talking about here might be a little bit different than what's actually happening in your market. But at the end of the day, it always comes down to supply and demand. As you can see from this chart here, Orange County inventory is sitting at the lowest level for the end of May that we've ever recorded on record, which began tracking back in 2004. At the time I'm filming this video, we have 2,225 homes on the market, which is nearly 500 homes less than we had last year, sitting at 2,697, and well below the 3-year average between 2017 and 2019 at just over 6,370 homes. Now, with that said, if you want more specific data on the Orange County housing market, I actually started another YouTube channel to talk about Orange County as well as my local market here in Huntington Beach, which I'll link to in the description below. Now, you might be watching this going, Jeb, you're absolutely crazy. There is no world in which I'm buying a home, especially in this market. Well, I understand you have to do what is right for you when it's the right time in your life. But at the same time, I want you to take a look at this chart here, showing that in the last 20 years, rent increased by nearly 135%, whereas income growth only increased by about 77%. So I'm not here to push you to buy a house, but I am here to point out 3 things with regards to home ownership. 1, it stabilizes the largest single item in most people's budget, which is your rent. 2, by paying down the principal every single month, not only are you putting money into a forced savings account, chances are you're getting tax benefits as well. And the 3rd thing it does is help you create generational wealth while being able to reap the rewards of appreciation over time.